Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at intuitive machines.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And before we get into today's stock, here is a useful tool for investors who want a faster and cleaner research workflow. You can check out stockanalysis.com Pro through the link below in the description. Use discount code ITT for 10% off. Stockanalysis.com is lightweight, fast, and works on desktop, iOS, and Android. The free version is useful for checking stock prices, financials, charts, forecasts, and news. But if you want deeper research, stockanalysis.com Pro gives you no ads, saved screeners, watch lists, portfolios, long-term financial history, dividend history, analyst filters, ETF data, and exports to Excel, CSV, and Google Sheets. Pro comes down to about $5.93 per month when billed annually after the discount. For heavier users, the unlimited plan adds unlimited downloads and unlimited stocks per watch list and comes down to about $14.93 per month when billed annually after the discount. Stockanalysis.com is a research tool, not financial advice. It does not tell you what to buy or sell, and it does not guarantee investment results. Always do your own research and make your own investment decisions. This is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
So, imagine for a second being the only private company on Earth to successfully soft land a commercial vehicle on the moon.
Yeah, it's wild.
Right. I mean, that's not science fiction anymore. That actually happened with their IM-1 Nova C mission. It's just a staggering feat of engineering. But for our talk today, we're really focusing on the market mechanics. Like, why does this matter right this very second?
Exactly. And, the answer is that Wall Street is currently on an absolute, just frenzied hunt for a SpaceX proxy trade.
Yeah, they really are.
That's the exact dynamic driving all this insanity we're seeing on the chart. You have this massive pent-up institutional demand for space exposure. But here's the catch, right? Institutional money can't just log into a brokerage and buy shares of SpaceX.
Right, because it's completely private.
Exactly. Unless you're some elite venture capital firm, you're totally locked out. Yet you have these portfolio managers, and they have strict innovation mandates. They have literally billions of dollars in capital they need to deploy into the space sector right now.
So they have to look elsewhere.
Yeah, so what do? They aggressively look for the premier publicly traded lunar infrastructure proxy. And right now, Intuitive Machines is just sitting there as the ultimate magnet for that capital.
Makes sense.
When that IM-1 mission actually touched down, it fundamentally shifted their whole narrative. They went from being, an ambitious startup to a validated, proven operator in the space.
All right, let's move into the wealth building context. Because while planting a flag on the moon is undeniably cool, we really have to look at this through a ruthless, risk-aware lens for our listeners.
Absolutely. We have to look at the money.
Right. Is space exploration actually a predictable long-term wealth builder for your portfolio? Because if you look at the history of early space stocks, I mean, they look terrifyingly similar to early, highly speculative biotech companies.
Oh, totally. The parallels are definitely there.
You've got massive cash burn, years of agonizing research and development, and just a deeply binary outcome. You are either making history or you're quite literally blowing up your investors' capital on the launch pad.
Literally blowing it up, yeah.
So we really need to figure out, is this just a shiny novelty play, or is a sustainable business model actually emerging here?
And that is exactly the right skepticism to bring to this, because the investment thesis here, it actually relies on them transitioning away from that speculative phase.
Right.
The wealth building potential doesn't come from treating them as an R&D outfit trying to pull off stunts. The real value for you as an investor is in their shift toward becoming a picks and shovels infrastructure provider for the emerging lunar economy.
Okay, unpack that a bit. What do you mean by picks and shovels in space?
Well, think about it like this. NASA's Artemis program and the broader commercialization of space, they require a backbone. Someone has to provide the internet routing, the payload deliveries, the mapping data.
Yeah, I see.
Intuitive Machines is aiming to be that foundational infrastructure that allows everyone else to operate in space. We're talking about generating recurring commercial space infrastructure revenue, and that is a completely different, much safer business profile than a company just, crossing its fingers for a single successful rocket launch.
Now let's look at the fundamentals. Because if we're going to buy into this whole infrastructure transition story, well, that story absolutely has to show up in the math.
It has to, yeah.
We need to see it directly on the balance sheet and in their revenue visibility. You can't build a retirement portfolio on a sci-fi narrative.
You certainly can't. And that brings us to the massive game changer for their balance sheet. That's the Near Space Network Omnibus contract known as the NSN.
The NSN, right? This is the big one.
It's huge. This is an agreement from NASA, and it has a ceiling valued at up to $715 million over 5 years.
Wow.
And to understand why this is such a big deal, you have to look at how aerospace companies usually make their money. Historically, their revenue is just incredibly lumpy.
Lumpy, right.
Yep.
Like getting paid only when you cross a finish line.
Exactly. They get paid based on specific engineering milestones. You pass a design review, you get a check. You finish building a chassis, you get a check.
And Wall Street absolutely despises lumpy revenue.
They hate it. Because if a supply chain issue delays a titanium part by 2 months, the company completely misses their quarterly expectations and the stock just gets crushed.
So how does the NSN fix that?
The NSN contract changes that entirely. It gives them unprecedented top-line visibility. It physically transitions them from sporadic milestone payouts to a structured, highly predictable master service agreement.
Okay, I hear that. And the visibility is great, but let's be real here. That $715 million is a ceiling, right? It's not a guaranteed lump sum sitting in their bank account today.
It's true. It's a ceiling.
They have to actually execute task orders to see that money, and we have to bring a cautious breakdown to the financials as they stand today. Because right now, their free cash flow is still heavily negative.
It is.
They are dealing with massive capital expenditures, or CapEx, to prepare for the upcoming IM-2 and IM-3 missions. Building flight hardware and integrating lunar rovers, I mean, that burns cash at an astonishing rate.
It definitely does. Space hardware is not cheap.
But, to be fair, I will say the liquidity concerns that usually just terrify me with microcap companies, they've largely been alleviated here.
Yeah, they are actually in a decent spot right now.
Right. They have a solid cash position at the moment thanks to recent warrant exercises and at-the-market offerings.
Which is a really crucial distinction to make for anyone tracking microcaps.
Exactly. Because for those unfamiliar, an at-the-market offering, or ATM, is essentially a way for the company to slowly drip new shares into the open market to raise cash. It's way better than dumping a massive secondary offering all at once that completely crushes the stock price.
It's much healthier for the chart, yeah.
And more importantly, Intuitive Machines has completely avoided the toxic, high-interest convertible notes that absolutely plague their peers.
Oh, the death spirals.
Right. Toxic convertibles create a death spiral where lenders short the stock to convert their debt into massive amounts of cheap shares, which just obliterates retail investors. Intuitive Machines dodged that bullet. But still, that negative cash flow is a reality we have to accept.
It's a reality, but it's a designed reality at this stage of their life cycle. All of that negative free cash flow, it's being relentlessly reinvested into growth.
How so?
The best way to visualize this mechanism is to think of it like building a toll road. The initial construction, laying the asphalt, building the toll booths.
Which in this case represents the R&D in building the physical lunar landers.
Exactly. That initial phase is incredibly capital intensive. It drains your cash reserves completely. But once that road is built, the ongoing maintenance is minimal compared to the revenue it generates.
I see.
Once their lunar infrastructure is physically sitting on the moon, the recurring data transmission revenue from the NSN contract kicks in. They are essentially charging NASA a toll for every single megabyte of data sent back to Earth.
That's a great analogy.
Right. And because of that shift, we expect their gross margins to dramatically expand, moving from the high teens right up toward the mid-30s as they leverage that fixed cost hardware.
Yeah, that toll road analogy clarifies a lot. It also highlights what I view as their strongest fundamental attribute, which is their competitive moat.
Oh, absolutely. The moat is huge here.
Because they operate under NASA's Commercial Lunar Payload Services Program, or CLPS, which acts as this massive quasi-regulatory barrier to entry. I mean, think about the engineering reality here.
It's so complex.
Right. Once Intuitive Machines is contracted and physically integrated with specific NASA payloads, meaning scientists have spent years designing their instruments to perfectly fit the power, thermal, and data specifications of the Nova-C lander, the switching costs become prohibitively high.
They really do. NASA can't just change their minds.
Exactly. NASA can't just unbolt a sensitive lunar rover from an Intuitive Machines vehicle at the last minute and, duct tape it to a competitor's lander.
Right. The engineering integration is far too complex for that.
Right. That effectively locks out peers, like Astrobotic, for those specific delivery slots. It's basically a structural monopoly for that specific mission.
That brings us to the catalyst timeline, because we have strong fundamentals and we have a widening moat, but the market is a forward-looking machine.
It is. It only cares about what's next.
Exactly. We have to connect these fundamental realities to the specific upcoming events that will physically unlock the stock's value.
Right. So what's the actual trigger? What's going to move the needle in the near future for you?
First, you have to look at the upcoming Q2 2025 earnings report. The single most important metric to watch is the conversion of those NSN task orders we just talked about.
Okay, so the actual billing.
Yes, the market knows the $715 million ceiling exists, but they want proof. They want to see the actual billing begin. If management announces an upward revision in their 2025 guidance based on locked-in task orders, it could trigger a violent short squeeze.
And let's unpack why that squeeze would happen for a second. There is a massive amount of short interest in small-cap space names right now from hedge funds who are betting these companies will run out of money.
Lots of betting against space right now.
Right. So if Intuitive Machines proves they have accelerated guaranteed revenue, those shorts are suddenly trapped. They will be forced to buy back the stock rapidly to cover their positions, which just drives the price up even faster.
Exactly. And beyond earnings, you have the physical mission milestones, too. Space stocks don't just trade on standard quarterly spreadsheets, they trade heavily on hardware readiness.
What are we looking for there?
Specifically, we're looking at the preparation and the static fire testing for the IM-2 mission, which is targeting late 2025 or early 2026.
And a static fire is what exactly? Just for everyone listening.
A static fire test is this critical mechanism where they literally bolt the fully assembled rocket to the launch pad and fire the engines at full thrust without actually launching.
Okay, so it stays on the ground.
Right. It tests the telemetry, the pressure
Yeah.
systems, the software, everything. And when a company successfully completes a static fire, it massively de-risks the mission in the eyes of the market. It proves the engineering is sound before the actual launch day.
Which usually triggers a wave of confident buying, I imagine.
Huge waves, yeah.
And then we have to talk about the macro catalyst, the absolute elephant in the room here. And that is the highly anticipated SpaceX IPO.
The holy grail for space investors.
Exactly. Whenever that happens, whether it's an official S-1 filing or just a confirmed date announcement, it's going to trigger an explosive re-rating of the entire space sector.
Oh, it's going to lift every boat.
Right, because when a behemoth like SpaceX goes public, it establishes a premium valuation benchmark for everything remotely related to space. And high beta names, meaning stocks that are extremely volatile and hyper-correlated to sector momentum like Intuitive Machines, well, they're positioned to benefit disproportionately.
They really are.
Institutional money that misses out on the SpaceX IPO allocation will just panic buy the next best liquid proxy.
Now let's pivot to the chart, because we need to examine how the market is physically trading this stock right now ahead of all these catalysts we're tracking.
And the price action here is, well, it's not for the faint of heart.
Definitely not.
It is classic, high beta, momentum-driven behavior. Just recently, we saw this massive vertical rally on a Thursday, which was immediately followed by a sharp 13% dive on Friday.
A pretty wild swing.
Yeah, and from my cautious standpoint, I look at that and see a massive red flag. When a stock gets back 13% in a single trading session, that tells me the buyers are incredibly skittish. It shows how quickly the momentum can evaporate if the hype dies down for even a second. Is this a falling knife situation?
I get why it looks scary, but structurally speaking, a 13% pullback after a massive multi-day vertical breakout is actually incredibly standard.
Really? Standard?
Yeah, in technical analysis, we refer to this specific pattern as a bull flag or a pennant formation. So the stock surged upward on huge volume, right? That creates the flagpole. And now it's trading in a tight, slightly downward channel, which forms the flag. It is physically digesting the recent gains. Short-term profit takers are exiting, and new institutional buyers are stepping in to establish their base.
Oh, I see.
It's a required period of consolidation before the next leg higher. It's not a reversal of the primary bullish trend.
So you're reading that as a healthy pause,
Yeah.
a shakeout of the weak hands. rather than underlying weakness.
Precisely. And if you dig into the volume metrics, there is undeniable institutional support here. We are seeing major whale alerts triggering across the industrial and space sectors.
Explain that dynamic a bit.
Well, because the float, the actual number of shares available for public trading is relatively small in these niche companies. When large institutional players start aggressively accumulating shares, it creates an outsized upward shock to the price.
That makes sense.
Furthermore, you have passive capital stepping in, which is huge. The UFO ETF, which is the premier space exploration index fund, just hit $1 billion in assets under management.
And let's explain why that specific ETF milestone matters to our listeners. It's not just a vanity metric, right? It creates a forced structural bid.
Exactly.
When a massive pension fund decides they want space exposure, they don't bother picking individual stocks. They just buy millions of dollars of the UFO ETF.
But it's way easier for them.
Right? And because of how ETFs are structured, the fund managers are then legally obligated to go into the open market and buy shares of intuitive machines to match their portfolio weightings. It creates relentless, price-agnostic buying pressure that puts a floor under the stock.
So what does market sentiment look like? We see the structural buying on the chart, but what is the broader Wall Street narrative that is actually driving those initial trades?
Well, the overarching narrative is pure, unadulterated space mania right now.
Space mania is definitely the right phrase.
Analysts are falling over themselves to get bullish. As we established, Wall Street is hunting for SpaceX proxies, and we're seeing major upgrades reflecting that exact desperation. Rod Capital, specifically their analyst Suji De Silva, just maintained a buy rating and aggressively raised their price target from $50 up to $75.
Which is massive. Raising a price target by 50% in one move is a huge signal of conviction.
It really is.
Wall Street analysts are usually incredibly conservative with their targets to protect their reputations, Pushing it to $75 shows they have really run the math on that NSN infrastructure transition.
Right.
And they deeply believe the recurring revenue ramp is going to dramatically outpace current market expectations.
I see the bullishness. I really do. But I want to cautiously address the rumor mill for a minute. Because it's spinning totally out of control right now.
Oh, the rumors are wild.
During these mania phases, people want to believe the most optimistic scenarios imaginable. There is a lot of speculative chatter floating around about intuitive machines potentially being added to broad-based aerospace indices like the Russell 2000 or even specific S&P mid-cap tiers.
Which would trigger even more of that forced passive buying we just discussed.
Exactly. You also hear wild whispers about them securing strategic partnerships with major prime contractors. Some are even speculating a direct infrastructure tie-up with SpaceX itself for future lunar return architectures.
That would be insane.
It would be, but I want to stress heavily to you. These are entirely unconfirmed rumors. Nothing is verified. But the sheer fact that these rumors are gaining so much traction perfectly illustrates the fever pitch, highly emotive sentiment surrounding this stock right now.
Now let's talk about the risks. Because sentiment can turn on a dime, and we have to ground this high-flying Wall Street narrative with the incredibly harsh realities of the sector itself.
The realities are brutal. I mean, to put it as plainly as possible, a rocket explosion is very bad news for space mania.
The worst news.
Execution risk is paramount here. The vacuum of space is entirely unforgiving, and orbital mechanics don't care about your stock's bull flag pattern.
No, they certainly do not.
If the upcoming IM-2 mission fails to achieve a soft landing, or honestly, even if a peer company like Astrobotic experiences a catastrophic failure on the launch pad that discussed the broader market, the premium valuation that Intuitive Machines currently enjoys will just evaporate overnight.
It's true. Investors suffer from guilt by association in nascent sectors.
Right. You're operating in an environment where the margin for error is essentially zero.
It's the existential risk of the industry, and it really can't be ignored.
And tied directly to that is the valuation and dilution risk.
Yeah.
I mean, a stock dropping 13% in a single day shows us clearly that it is priced for perfection. Any delay in the NASA timeline, any minor technical hiccup on a static fire test, and it will be severely punished by the market. Furthermore, bridging that financial gap, getting from the negative free cash flow they have today to the positive free cash flow of tomorrow that often requires tapping the equity markets. If they miscalculate their CapEx and have to run another share offering before the NSN contract fully ramps up, existing shareholders are going to suffer immediate dilution. Your slice of the pie gets smaller.
Those are incredibly valid, sobering risks. However, I think there are strong structural mitigations in place right now that protect the downside far better than they did a year ago.
What kind of mitigations?
Well, regarding the execution risk, yes, space is hard. But Intuitive Machines is no longer dealing with theoreticals. They already de-risked their proprietary propulsion and navigation algorithms with the historic IM-1 landing.
Right, they actually did it.
Exactly. They have a physical, proven historical success rate that their immediate peers simply lack. They aren't hoping their telemetry works. They know it works.
That's a fair point.
And regarding the dilution risk, that $715 million NSN contract drastically changes the calculus. Even if they only draw down a fraction of it initially, the borrowing power against that master service agreement significantly reduces their need for the kind of painful, highly dilutive capital raises they relied on prior to 2024. They have a visible, mathematical path to profitability now.
So with everything on the table, what's the final verdict?
Based on the synthesis of the underlying research, weighing the undeniable fundamental strength and institutional backing against the sector's inherent existential risks, the bullish score sits at a very strong 8 out of 10.
Wow, an 8 out of 10.
Yeah, here is the final elevator pitch for you. You are looking at a company with an undisputed quasi-regulatory technological moat and a true first-mover advantage in the burgeoning lunar economy. They are sitting right at the epicenter of structural capital flows as Wall Street desperately seeks out proxies ahead of the SpaceX IPO. And structurally speaking, that recent 13% dip looks exactly like a healthy and necessary cooldown in a newly forming bull cycle. It's offering a high conviction entry point before they start dropping major mission milestones.
From a long-term strategy perspective, I'd say the playbook is fairly clear. You can treat this as a high-beta momentum swing trade directly into the SpaceX IPO cycle over the next 6 to 12 months, simply riding that rising tide of aggressive sector sentiment. But you should also seriously consider maintaining a core long-term hold reserve for the 18-plus month horizon. That's really when the heavy lifting of the initial capital expenditures begins to fade away. The toll road is fully built, and the recurring high-margin revenue from the NSN contract is finally realized on the bottom line. If you want to build a cleaner stock research workflow, you can check out stockanalysis.com Pro through the link below in the description. Use code ITP for 10% off. Pro comes down to about $5.93 per month when billed annually after the discount, and Unlimited comes down to about $14.93 per month when billed annually after the discount. Remember, stockanalysis.com is a research tool, not financial advice. It does not guarantee investment results, and you should always do your own research before making any investment decision. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.